In today's episode of the Daily Brief, I'll talk about two interesting stories. I first talk about a household name in your kitchen going public, and finally, I talk about how Indian IT grades this quarter. Welcome back to the Daily Brief show by Zerodha, where our aim is to simplify the biggest news in the financial markets in a way that's one level deeper as compared to news channels. I'm your host Akshara, and today is Wednesday, 29th October. Coming to the first story, Orkla India is an odd company to assess. It's a subsidiary of a Norwegian consumer products giant with a foot in everything from seafood to fabric conditioners. Orkla India, though, runs the most Indian of businesses, selling masalas. And its history, too, is characteristically Indian, touching everything from the rise of Udupi restaurants to the emergency. So Orkla began its life as an offshoot of Bengaluru's legendary Mavalli Tiffin Rooms or MTR restaurant chain, which recently completed 100 years. The restaurant chain is legendary in its own right. It's one of the most prominent bastions of Udupi cuisine in the city. But in the 1970s, a quirk of history forced it to enter the packaged foods business as well. In 1975, during the emergency, the government imposed the Food Control Act. The law forced a price cap on restaurants, and suddenly the restaurant could no longer stay profitable while maintaining its standards. And so, briefly, it was shut. To stay afloat instead, its founding family, the Mayas, started selling sambar and rasam powders as well as a variety of instant mixes from a nearby building. The emergency would eventually end, and in a few years, the restaurants would be back. But this new business was here to stay. In the 1980s, the two business lines were split between two brothers in the second generation of the Maya family. With the packaged foods arm going to Dr. Sadananda Maya and his relatives, it would stay with them till 2007 when it was sold to Norway's Orkla Group for $100 million. Orkla India is now planning to list its stock, and that gives us a window into a business we hadn't really thought too hard about before. So broadly, Orkla operates in two industries. It sells spice powders and what it calls convenience foods, which are ready-to-eat food, ready-to-cook, frozen food, and the like. In both these lines, it's making the same bet. India's food market is going to change. Take spices. Traditionally, people bought loose, unbranded spices from local markets, making the spice trade a heavily local, undifferentiated business. But as India urbanizes and people have more disposable incomes, they're increasingly buying packaged spices. Orkla expects that from a market of Rs 34,500 crore today, 40% of the total spice market, the packaged spices market, will nearly double to Rs 61,500 in the next 5 years, making up 45% of the market. Now, this opens up new possibilities. For instance, instead of buying individual spices and mixing them at home, a matter of great skill, people are moving to blended spices like sambar masala or pav bhaji masala that can make cooking easier and more intuitive. That's a value add that local traders might find harder to get right. The market for these alone could double over the next 5 years from Rs 11,500 crore to Rs 23,500 crore. Convenience foods, meanwhile, could see even more dramatic growth as a simple outcome of changing lifestyles. For now, this is a relatively small market, but across the world, as countries grow richer and more urban, and as women start working, people look for food that's easy to whip up. India too is getting to that point. And this could supercharge the segment's growth. Over the next 5 years, in fact, Orkla expects the ready-to-eat or cook market to grow by over 12% a year and the frozen foods market by 18%. But while the industry may change, what people like to eat remains remarkably consistent. This gives the industry a distinctly regional flavor. Brands cater to distinctly regional preferences, and so when it comes to a business like spice, India isn't one market but a variety of regional markets. But that can turn into a moat. Even if people migrate away from a region, in their food preferences, people still turn home. Indians in the Gulf, for instance, or Indians from the United States, still buy spices from Indian companies. Last year, India exported Rs 2,300 crore of branded packaged spices to places with a large Indian diaspora. This is a key channel for companies to leverage. Now let's understand Orkla's culinary universe. So Orkla has two marquee brands. The first is its legacy brand MTR, which caters to South Indian and largely vegetarian food like sambar powder or puliyogare masala. In 2021, however, the company also acquired the Kerala based giant Eastern. Eastern focuses heavily on non vegetarian food, rounding out Orkla's portfolio. So, roughly two-thirds of Orkla's revenue comes from selling spices, both pure and blended. The rest of its business comes from convenience foods. Now, India has many spice brands. Some, like Tata Consumer Products, have a much bigger presence than Orkla. But Orkla has made South India its stronghold. It leads the packaged spices markets of Karnataka and Kerala. In fact, in these two states, it claims to be present in the kitchens of 9 of every 10 households. It has large presences in Andhra Pradesh and Telangana as well. Now, the secret behind this dominance is its deep local customization. Consider the humble sambar. Every South Indian state has its own way of making sambar. Orkla understands this fact and caters to each state with a different formulation. Its MTR sambar powder caters to customers in Karnataka. Its MTR spicy sambar powder works better for Andhra and Telangana. Its Asal Kayam sambar powder works best for Kerala sambar. That is, the company has turned its unique cultural understanding into a moat. It's also a major exporter with 1 in every 5 rupees in sales coming from abroad. Eastern, in fact, has been India's most exported spice brand for 24 years. For its spices business, Orkla sources raw materials, turns them into powders, and packages them. It buys raw spices on temporary purchase orders from the company's network of 216 suppliers. Now, some of these links might be slightly fragile. For products like tamarind concentrate or asafoetida, for instance, the company has just a single supplier. Now, these raw spices go to one of its 9 factories where they're cleaned up and de-stored and then sorted to ensure that the flavor remains constant. The sorted spices are roasted, powdered, and packaged, and that's what lands up in your kitchen. This is a uniquely profitable business. Spices, at least in India, aren't a luxury. They're used daily in each of a day's main meals, and yet they can command serious margins. Blended spices, in particular, can carry margins as high as 45% to 60%. The company's convenience foods business is more complex. Here, it isn't merely processing spices, but cooking entire meals. What it does specifically varies widely based on the dish it sells, but typically these require considerable processing. The most complex, perhaps, are its ready to eat dishes, which must be cooked batch by batch in large industrial kitchens. The same complexity spills into other parts of the chain. Everything from packaging to quality control to transportation becomes more complex when you're dealing with cooked foods. Eventually, these packs make their way to the market. Most of its products are distributed through general trade, a mix of kirana stores, small kiosks, and the like. But increasingly, the company is shifting to newer ways of doing business. E-commerce and quick commerce are quickly becoming an important sales channel for the company. In the last year, in fact, its sales through digital channels grew by 46.5%. So far, this resembles any routine manufacturing business. But what's unique about this business is its product development cycle. Now, there are few products where people are as discerning as they are with food. For both its spice blends and convenience foods, nailing the right taste is critical. Now, that isn't a simple matter. It requires a deep base of knowledge. Orkla, for instance, runs 2 cuisine centers of excellence. The company sends its teams of chefs on culinary travels to learn about different parts of South India, understand its many cultures, and collect recipes. Through this process, in total, the company has developed a repository of over 4,000 recipes. Orkla's numbers convey a picture of growing operational discipline. Over the last year, the company's unit economics improved visibly. Its raw material costs dropped dramatically as a percentage of its total income, falling to 47.8% in FY25 from 54.9% in FY 2024. And with that, its operating margins expanded from 12.8% to 14.5%. Now, this is partly because the price of spices, the company's main raw material, deflated over the year. Those costs can rise again. But there are other indicators of good health. The company has practically no debt on its books with current borrowings of just Rs 2.3 crore. It's also spitting out cash remarkably quickly with its working capital days shrinking from 36.3 days in FY 2023 to 21.4 days in FY 2025. These are marks of a quality FMCG business. But not everything's positive. Despite projecting a rapidly expanding market, the company's own sales have been stagnant. In the last financial year, its company's revenues grew by a mere 1.6% year on year. The revenues from its spices business actually fell over the year from rupees 1,591 crore to rupees 1,571 crore. To be fair, the company sold more spice by volume over the year, increasing the volume sold by 3.5%. The deflation in the price of spices didn't just reduce the cost of Orkla's raw materials, it also brought the company's own prices down. And that's why the value of its sales looks diminished. But 3.5% growth is hardly groundbreaking. It's worth wondering if the company has much space left to grow, especially given its focus on a South Indian market that it already dominates. Even more worryingly, the company's factories aren't running at full capacity. Its capacity utilization, in fact, sits at approximately 46%, and this marks a substantial degree of variation. While some lines have utilization figures touching 90%, some are running at less than a tenth of their full capacity. Its confectionery unit at Lebanon, for instance, has consistently seen utilization figures below 7%. Now, this could be a troubling sign. It possibly shows that the company hasn't found the demand it was hoping for while setting up those factories. In a season marked by big ticket internet company IPOs, Orkla is an interesting stock market debutant. The company has a distinctly local story. Instead of spreading itself across the country, it's built itself a regional fortress. Its key moats are intangible. Its understanding of South Indian culture and its encyclopedic understanding of the tastes that mark this part of the world. But these moats, as its phenomenal margins and cash conversion record show, have helped it set up a formidable business. But is Orkla a good investment? That's the grand question. For all its claims, the company's growth has been flat. There's a noticeable slack in the company's factories. In fact, this issue is a pure offer for sale. None of the IPO proceeds will fund any future expansion of the company. So, where will the company's next phase of growth come from? If you're considering an investment, that's the question you should ask yourself. Now, coming to the second story. It's that time of the year again. The latest quarterly results are out for Indian IT companies. In our last report card, we reported a dismal Q1 FY26 for Indian IT, where the story entailed large-scale firings, delayed wage hikes, and declining revenues. As we've highlighted before, Nifty IT has generally not been doing well. However, the second quarter has been a little bit brighter for the industry, with results across the board being optimistic. The Nifty IT index hit its highest point since July 2024. But it's what's beneath the results that actually interests us. The industry overall has shown decent results, but some companies did much, much better than others. This piece focuses on the largest IT companies, TCS, Infosys, and HCLTech. But very soon, in another piece, we'll also cover some mid-cap IT companies that usually fly under the radar but deserve just as much of your attention. Let's get into it. So here's a quick note. When we say revenues for Indian IT, we mean revenues in constant currency. That is, adjusted for exchange rate fluctuations. This is because Indian IT is an export-heavy business that receives most of its payments in dollars. So the last few quarters have been rough for Indian ITs. In Q4 FY25, many companies saw declines in their business in successive quarters, the first time this has happened since FY 2021. Analysts have repeatedly reduced their expectations for how Indian IT will do each quarter, and IT firms might still miss those expectations. But this quarter fared much better in comparison. Let's start with Infosys. Its revenues rose by 2.2% from the previous quarter, recorded at Rs 44,490 crore. Operating margins continue to be steady at 21%, while net profit increased by 6.5% from last quarter to Rs 7,364. Now, the second half of the year is typically a bit muted for Infosys. But even then, Infosys has raised its expectations for how much their revenue will increase by the end of the year.
So let me start, and Jayesh will add in a couple of things. First, on the guidance and the environment. So in the guidance, typically we have the second half of the year is slower than the first half. That's the normal pattern. So we've continued with that pattern. Having said that, we've seen good traction, and that's how we've actually increased the guidance. The previous guidance was 1 to 3, and now it's 2 to 3. So in a sense, we have much more confidence with the lower end being increased in what we see into the outlook for the year.
Then there's TCS, who this year had the worst first quarter they've had since the pandemic. However, this quarter, they've recorded a measured recovery. Revenue came in at Rs 65,799 crore, up 0.8% from last quarter. Net profit reached Rs 12,904 crore, a slight increase from Rs 12,760 crore last quarter. However, it's worth noting that compared to the same quarter last year, the company's revenues continue to be lower. There's no denying that in the last 12 months, TCS's business has shrunk overall. Now, HCLTech recorded a really strong quarter with revenues up by 5.2% from last quarter to Rs 31,942 crore. Net profit stood at Rs 4,235 crore, up 10.2% from last quarter, while being flat compared to last year. However, this might not even be the highlight of their results. What's most notable is that HCLTech is reporting revenues from AI projects. And that's what we're coming to next. Every IT company has been talking up AI for the past year. In practice, though, they were stuck at pilot demos with no clear path to revenue. But this quarter, some firms gave us a clearer glimpse of how they're actually adapting to the age of AI. Now, there are two ways in which Indian IT companies are approaching AI. One, they're optimizing how they function internally, and two, they're trying to use it to improve client outcomes externally. Infosys and TCS mostly publicize the former, talking about how AI boosts worker productivity. And Infosys credited its internal Project Maximus, an AI-powered initiative for helping expand margins. TCS launched what it calls the world's largest internal AI hackathon. These are mostly small efficiencies introduced within the firm that don't materially impact the revenue and margins. The real prize, however, is to bring in money for AI-enabled services. There, HCLTech has taken the first big step, announcing $100 million or approximately Rs 882 crore in advanced AI revenue. Not much, mind you. It makes up less than 3% of their total quarterly revenue, but it's a start. More than anything, it's a sign of progress that their AI products are finally beginning to make real money in the outside world.
This quarter, we reached a major milestone by generating over $100 million in advanced AI revenue through our diverse service lines and IPs. This is about 3% of our total revenue. The credit goes to our exceptional teams across the company and the leadership for achieving this impressive milestone. Our people are embracing the transformation from a people-based business towards a model that seamlessly blends AI IP with human-in-the-loop capabilities. Over the past few years, we've made significant investments in building intellectual property, deepening partnerships, and strengthening our GTM and delivery teams. These efforts are now yielding results as we transition from the AI pilot stage to the AI monetization phase.
So, what does advanced AI mean? Well, HCLTech has built their own customized AI products that they are developing for their clients. This also means that they're investing in new assets, representing a slight departure from the asset-light business model that large Indian IT companies are known for. Of course, these products currently form a small part of their portfolio. Just like their peers, they're primarily a business that largely relies on putting lots of manpower behind IT maintenance projects. But their AI products mark a pivot, bringing in revenue from deals where AI and not manpower is the backbone of their offering.
And there are a couple of small products in HCL software. They also are being sold as IPs. So right now the IP component is small. Now going into your next question on what do we expect our IP trajectory to evolve. We believe this industry will have to evolve from being a pure labor-based service provider to people plus IP and platform-based service provider.
HCL has also pointed to the kinds of deals this entails. These are all interesting deals, from working with the Public Sector Transport Authority in Australia to creating a way to detect boat congestion in real time to working with the US aerospace major on software for precision manufacturing.
A Fortune 100 aerospace company chose HCLTech to create contour scanning software and a simulation testbed. Using physical AI and automation, HCLTech will support precision manufacturing, faster validation, and improved production efficiency. A US global manufacturer selected HCLTech AI advisory services to build an enterprise AI and governance framework to scale AI initiatives with measurable ROI, regulatory compliance, and responsible AI principles.
Not that HCL is the only company with an AI presence. TCS too has made a blockbuster announcement. It's investing $6.5 billion to install 1 gigawatt of data center capacity in India. This is a massive departure for TCS's asset-light model. The company traditionally maintained a return on equity over 50%, but that could change as it funnels billions into new infrastructure. So, why is TCS doing this? This could be a defensive play. TCS wants to ensure it can offer clients sovereign AI cloud options defending against AWS and Azure.
It's a passive data center. The likely users are could be the hyperscalers or deep tech who want to do the training inferencing in India, or Indian enterprises they want to leverage it as a private cloud. So these are the kind which we are not expecting our overseas customers to be hosted specifically in India. It's more like what we are offering for these hyperscalers and India-based businesses or deep tech.
But it could also be a bona fide investment. While AI monetization as a whole is still far away, data centers in India have become a huge business in and of itself. If we're in the middle of an AI gold rush, data centers are the shovel for digging that gold out, and TCS is buying a huge shovel. The real AI action, though, is happening in mid-cap IT firms, but we'll get to that in a different piece. AI isn't the only change these businesses are contending with. Indian IT is also trying to navigate a tariff and visa war kickstarted by the US. By all accounts, they're keeping their heads above water. Recently, we wrote about Indian IT's dependence on the H-1B visa for its offshore on-site business model and how the new H-1B rules, which increase the visa fee from $5,000 to $100,000, might impact the industry. We had summarized then that the impact of the change may be muted. Turns out that is indeed true. Our IT companies have been reducing H-1B dependency for years with a variety of strategies, be it shifting their offshore on-site ratio, increasing local hiring in the US, or even diversifying their business outside the US. All those moves seem to have paid off. The new H-1B rules have hardly derailed Q2 performance for any of the big wigs, with most of their business running on the back of their India-based workforce.
Finally, on H-1B, we have significantly localized our workforce in the US. Approximately just about 500 associates have traveled to the US on H-1B. We believe our business model will be able to adapt quickly to any changes in immigration policy.
They're also making active efforts to diversify the business regionally. Europe in particular, including the UK, has been the brightest spot for many IT companies this quarter. Infosys, for instance, saw their Europe business account for over 30% of all revenue after years of 5% plus annual growth.
On the Maximus and the hiring, Jayesh will come back. On Europe, I think Europe's done extremely well for us. We made some good investments in different countries across Europe. We've seen also, especially in the time you mentioned, the past 2 years, there's been a lot of opening up of companies in Europe in different countries to looking at the sort of services that we are offering, to looking at both transformation and cost efficiency. And there we've played quite well in those markets.
Europe also accounts for approximately 33% of TCS's revenue, growing over 5% year over year. HCLTech's Europe business has also jumped from making up 26.7% of the business last year to 28.3% now. On the other hand, North American revenues have been flat for many companies, despite making up over most of Indian IT's business. Infosys saw its North American revenues fall by 1.1% from last year. For HCLTech, the decline was even worse, dropping 2.3% since last year. Simply put, increasingly, Indian IT is banking on Europe to be a geopolitical hedge against new risks that come from the US. In a world that's increasingly uncertain, this is a must-have. Last quarter would have been terrifying for IT workers. Many companies had delayed wage hikes. Others had announced layoffs. Amidst all the uncertainty, workers were left holding the short end of the stick. But Q2 has marked a turnaround. TCS, for instance, has rolled out increments for 80% of its workforce. Despite this hike, its margins expanded, indicating better management of their costs. HCLTech has been confirmed that wage revision will take place in the next quarter. And hiring has shown a comeback. With the exception of TCS, every major firm added employees in Q2. Infosys led with 8,203 net additions, its largest quarterly hiring in over a year. And they will be hiring more.
So if you look at our hiring for this quarter, our net addition is already at 8,000. We had given a guidance in terms of the fresh hiring for the year, and we had said 15 to 20,000 what we expect. We have hired in the first half 12,000 plus freshers already, so we are well on our track to hire close to 20,000 this year.
HCLTech grew its workforce by 3,489 employees as well, while Wipro added 2,260 employees. To a large degree, this is cyclical. Freshers who graduate in May-June usually join these companies by September-October. TCS, however, hasn't stepped into the job market. In fact, its headcount is down by nearly 20,000 people, or 3% of the workforce. While some of them left voluntarily, most were simply let go. TCS claimed it was clearing redundancies and skill mismatches, which means possibly TCS overhired previously and are now normalizing. In fact, some companies are getting selective about hiring. None of these companies are mass hiring anymore. They're being selective, focusing on their AI, cloud, and consulting lines. Where possible, they're turning to their existing bench capacity to handle excess load. Infosys, for instance, upped utilization from 82% to 85% and is still there. Tech Circle quoted an HR executive at a large IT firm who said, "Automation and Gen AI are changing delivery models. The focus is on reskilling and hiring domain experts rather than scaling volume." In summary, the second quarter has marked a steady comeback for our largest IT companies. Both revenues and profits have been up, and we're finally seeing first signs of the industry finally waking up to the AI opportunity. However, does this indicate the start of a larger recovery? Indian IT has been stagnating for a few quarters, and some of this newfound growth comes from a lower base. We'll need to see more before we can confirm that this is a resurgence. The more interesting story, meanwhile, lies in our mid cap IT companies' rip roaring growth this quarter. But that's for another episode. Indian IT may not become obsolete in the age of AI. But beneath what seem to be stable results, the industry is certainly in a state of flux. Now, coming to the tidbits. Amazon plans to cut up to 30,000 corporate jobs, nearly 10% of its 350,000 corporate workforce, to reduce costs from pandemic overhiring and leverage AI driven productivity gains. Coming to the next tidbit, a New Zealand insurer, Maritime Mutual, facilitated billions in sanctioned Iranian and Russian oil shipments by providing crucial insurance to shadow fleet tankers, helping transport $18.2 billion of Iranian oil and $16.7 billion of Russian energy products. Coming to the final tidbit, Axis Bank is selling its Rs 511 crore debt exposure to bankrupt Lavasa Corp at a reserve price of Rs 80 crore as lenders seek exits from the 7-year insolvency case hampered by ongoing litigation. That's all the news I have for you today. Thank you so much for watching and see you in the next one.
Disclaimer: this content is for informational purposes only. None of the stocks, brands, or products mentioned are recommendations or endorsements.